Welcome to the ABFER and Without Co webinar on capital market development, China and Asia. Today, we are very fortunate to have a wonderful paper by Professor Ellen Wong on social media live stream, investors' information or persuasion. And also, we're very blessed to have an excellent discussion. Professor Charles Lee from U of Washington and also Stanford. Without further ado, Alan, actually, I think the audience know both of you very well. Would you mind to start? 25 minutes, please.
All right, thank you. Let me go ahead and share my slides here. Hope this is working. Thank you very much for the opportunity to present this paper here. And thank you in advance to Charles for providing the comments on the paper. So in this paper, we look at social media live streaming, and we are looking at the phenomena in China specifically. And the research question that we have is whether this type of social media live streaming is giving information, useful information to investors, or whether they serve only as persuasion tools to investors. Now, the paper is co-authored with deHaan in Stanford University, and a PhD student, Srijith in HKUST, who is happened to be on the market this year. So if you guys are looking to hire, please take a look at him. And also Lu, who was a former PhD student at HKUST and now working in Southwestern University of Finance and Economics. Now, in terms of the motivation of the paper, mutual funds comprise a very heavy load of household savings. In the US, there are about $22.5 trillion of mutual funds. And in China, starting from the early 2000s, the growth in mutual fund industry is really substantial. And now there are more number of mutual funds than the number of stocks or bonds in China. So the total AUM in China's mutual fund is about 4 trillion. Now, despite the fact that mutual funds accounted for a substantial part of investments in households, prior research find that households struggle to make very well-informed choices. Many mutual funds underperform the market, especially active mutual funds after we subtract the fees. There's a huge dispersion of fees, even among identical index funds. A Journal of Finance paper by Elton et al. In 2004 find that if you just invest in low-fee index funds, you're much more likely to outperform those high-fee index funds, which usually invest in similar type of assets. And deHaan's paper in 2021 find that mutual funds, some of them charge low fee, some of them charge high fee. They seem to have an equilibrium in which that the high fee funds are using disclosure complexity and to obfuscate information, which trick the investors into investing in high fee mutual funds. Now, due to these reasons, there's been decades of regulations on mitigating these information frictions and improve investor decisions. In the US and in China, asset management firms' disclosure are heavily regulated. There are numerous rules in China and also in the US by SEC and FINRA, etc., about what funds can disclose and who they can disclose to. Now, despite the fact that these rules exist, we can see that funds are still trying to circumvent the rules and trying to disclose information to obfuscate investors. Usually, funds have very limited chance to disclose with investors. Other than IPO perspectives, we have annual and quarterly reports, and also the shareholder letters once a year, twice a year within those reports. Now, fund advertisings are heavily regulated by the regulators. So we usually see this type of advertisements in newspapers, in money magazines, etc. Now, due to the limited space that they have, and also they can't really disclose much information, heavily regulated by the regulators, these advertisings usually are in very short formats, and they very much highlight the past performance. So here are a few examples from the advertisements in the 90s and early 2000s. Now, as you can see, they don't really say a lot about what the fund's investing in because those information are not really sanctioned by the investors, sanctioned by the regulators. They focus on what are the past performance of the funds, and they typically have someone that are very authority-looking and competent-looking guys signaling the type of the funds and that your money will be in good hands. Now, fast forward to the last couple of years, even though the asset management industry and the number of choices available and the type of investments available has grown substantially. But you can see that in terms of advertisings, they are pretty much the same. So they don't give you a ton of details about who the managers are. They don't give you details about their investment philosophy, etc. They tend to just focus on the past performance itself and also the names. So in terms of the motivation, given that this is the type of communication that funds can have with investors, if we look at the past results, past research on mutual funds advertising, they tend to find that these advertisings have a very minimal amount of contents, and the funds that advertise usually have poor future performance. So the canonical paper on this is Jane and Wu's paper in 2000, and they find that funds that are in advertising, and I think they use Money Magazine as as a sample, tend to have very good performance prior to the advertisements, but after the advertisements, the performance of the funds tend to underperform those that are not in the advertisements. Now, in our paper, we're looking at a different setting. We're looking at Chinese mutual funds live streams. Now, these type of live streams started on the fintech platforms in about early 2000s. And so basically, early 2020. Basically, during the COVID period, after the COVID lockdown in China, funds in China started to see that they cannot do typical roadshows as before. So instead of the roadshows, they start to use fintech platforms to try to communicate with retail investors. So the number of funds that live streams grows substantially in 2 to 3 year period right after 2020. And until right now, a majority of the funds would have some sort of setups where they live stream to investors on a weekly basis. Now, if you look at these type of live streams, they're very well organized. The channels are usually run by the fund family with a regular host and dedicated studios. And one of my EMBA students is the head of marketing in one of the funds in mainland China. And she took me to the studio in Shenzhen. And I look at the studio, they are professional grades. So these are the studios that they spend millions of dollars to build. And these are studios that they're not just like the early COVID period where people would just live stream from their homes. So in addition to the host and the dedicated studio, they also invite fund managers to join the live streams or fund analysts to join the live streams. All of the speakers.
A quick one.
Sorry,
Is
yeah.
it only China or is also in other countries?
It's mostly in China. I haven't seen similar cases outside of China yet. Okay, so in terms of the professionals, the speakers, they must have asset management certificates. Fund managers and fund analysts attend these live streams frequently. Now in our sample, we look at about 27,000 live streams and covering 91% of the fund families China. So all of the large ones would have live streams in our sample here. Now these live streams are on average about an hour long. And these live streams carry a very wide range of topics. And we did an LDA topic analysis later on, and you can see some of the topics. So they cover not just the recent performance in the market, monetary policies, asset allocation strategies. They also cover global economy. They cover sector and industry-specific information, such as the AI sectors, technology trends, liquor industries, etc., etc. And in addition to this type of, in addition to the format that is an hour long, they also field questions from investors. So speakers would answer questions either live or those questions that are submitted in advance. And they are quite popular on average. They're about 47,000 viewers each. And you can very easily sign up for live streams ahead of times by using the fintech apps, and they will send you a message when the live stream turns on, so you can see the live streams at that time. And in addition to the live stream in addition to discussing the performance, etc., these live streams, being on the fintech apps, they are also licensed to sell the funds themselves. So during the live streams, they're also going to showcase selected funds with an option to buy. So here is a print screen of one of the fintech app, Tian app, Tian funds. This is one of the two largest fintech platforms that sells the funds in China. If you look at this is the Nanfang Jijin, so basically one of the largest funds in China. And this is the live stream titles. They have the speaker's name and also their job functions. And over here on the left, on the lower left corner, you can see that there are 14 funds within the shopping carts. And if you are interested in purchasing, you can click on that and you can see the funds that they have in the shopping carts. You can purchase the funds immediately or add it to your selected list where you can purchase the funds later on. And similar to other type of advertisements or other type of communications by the funds, there are very limited amount of information that they can put in here. So for example, if they put the performance data need to be either since the inception or a certain fixed time horizon that the regulator allowed them to do. This is to prevent the funds from selectively presenting the performance in a given period that tend to paint a better picture of the performance of the funds. Now, they are permitted in China as investor educations. So this is specifically sanctioned by the Chinese regulators for mutual funds, the AMAC, in 2021, that this type of live streams, they are not categorized as advertisement per se. They are categorized as investor educations. In fact, if you look at the mutual fund families, every year, each mutual fund would need to disclose how much they spend on investor educations, what type of activity they do. And this is included, live stream is included as one type of activities in that. Now, to show you some more color on what type of information are discussed, this is one of the extreme example, but this is one of them. That one of the fund during their live stream is trying to basically explain what is a CAPM model. So what is alpha, what is beta, how do they hatch the beta part, and how do they focus on the alpha part? And you can see that they are the host over here. This is the host, and this is one of the fund managers. The fund manager is trying to explain how does he hatch the alpha part by short selling the index and then focus on the beta part. And he's trying to struggling to basically use a few pieces of paper to explain the CAPM model. Now, I to be honest, I would say that I watched about dozens of live streams, and I listen to live streams. I find that there are quite a lot of information that I learned from the live streams, not about the CAPM per se, but mostly about the industry trends, etc., etc. So now our question that we have is, are these live streams actually informative or to the retail investors, or are they only serving as advertising tools to attract the investors to buy into the funds? Now, in terms of the informations, live streams it is entirely possible that live streams are only attended by high-type funds or high-type managers, and they can signal future outperformance. Now, managers carry a very significant part of the live stream cost from managers, in addition to the cost by the mutual fund family that we see earlier in terms of the studio, etc., the physical costs. But managers have to prepare for the live streams. They have to risk poor Q&A performances. And there's also sort of an implicit commitment to the fund performance. Because when you discuss live streams, if you discuss your investment strategies, now, first of all, you could disclose proprietary information that the others can use to trade ahead of your funds. And second, when you disclose something about what you expect will happen with certain industries, there's sort of a commitment to follow up with that investment strategy. So you are sort of tied into that investment strategy that increases the cost as well. And second thing is that investors can infer the fund's manager's skills from the discussions. When I was listening to the funds, I literally felt like listening to the live streams, I literally can learn. For example, when I was listening to one manager talking about the liquor industry in China, he has a very detailed discussion about what type of liquor suits what situations. It's not just multi, but then the certain lower or medium level liquors in China are suitable for what scenarios, and how does the economy development affect the consumptions trends in different liquors, etc. So after that, I do felt that I learned quite a bit, and if I want to invest in liquor, maybe I should invest in a fund that's managed by this manager here. So if we follow with the informative discussion here, the prediction would be that live stream funds is going to demonstrate superior subsequent performance. Now, on the other hand, it's also possible that the live streams are intended to just persuade the investors to buy regardless of the future performance. So basically, they're only serving as a tool of the advertisements, similar to what we see as the early advertisements in the early 2000s, where you only see the performance. And even though the managers are high skill, but maybe their skill is only in presentation, it doesn't really predict the fund's performance. So if we follow this, then live stream funds may demonstrate inferior subsequent returns. So a preview, in terms of preview of our findings, we find that live streams follow bouts of strong performance. So this is consistent with both the informative views and also the persuasion views. We also find that consistent with the fund families making rational decisions and on investing in the live streams do drive fund flows. They do increase fund flows. However, when we are trying to look at the future performance of the funds, we find that the live stream funds have lower performance in the funds, and also the investors' buying decision are worsened by the live streams, which are only consistent with the persuasion hypothesis. So let me go ahead and share more about the sample and also the results that we find. As I talked about before, we have about 27 funds, 27,000 live streams. In our sample, we focus on about 18,926 fund class. And as you can see, the number of fund families that engage in live stream increased substantially in the first couple of years and stayed about constant over after that period from 2022 until the end of 2024. On average, live streams have 53 minutes, 47,000 viewers. There are on average about 2 speakers on the live streams. On average, they feature about 3.88 funds in their shopping carts. Most of the live streams the majority of live streams focus on 1 or 2 topics. So the largest topics, when we classify the topics by LDA using 10 topics, 44% focus on 1 topic in terms of the length on the time on the live streams, 21% focus on the second topics. And they discuss a very variety of the number of topics. Some of them relate to the general market conditions, some of them related to a specific industry. So most of the live streams would have a speaker. About 27% of the live streams are attended by fund managers. 17% of the live streams are attended by one of the fund analysts. Okay. Now, let's first take a look at the determinants of the live stream funds. So basically, when a fund family live streams, they can determine which funds to feature in their shopping carts. And we find that the live stream funds tend to have higher recent performance. So these are the good performing funds. That's why they're included in the carts and they are attractive. And at the same time, these funds have higher service fees and lower loads. So basically, these are the funds that are easy to buy, not expensive to buy, and they charge higher fees. So these are the funds that are being featured by the fund families itself. We take a look at the flows that are the flows that are associated with the funds. And so basically, fund live streams do attract higher flows into the funds. In terms of the first live streams, there are about 39% higher fund flows within when we have a 1 within fixed effect standard deviation. 39% of the within fixed effect standard deviation of fund flows increase during the quarter that we have the first live streams, and there's a lower effect after that. Some of them are driven by subsequent live streams because funds tend to be included in the live streams in consecutive quarters. Now, other than these results, we see that the repeated live streams then also can draw in fund flows. The effect is slightly smaller than the first live streams, but about 37% in terms of economic magnitudes. Now, the next one that we look at is, given that live stream funds tend to have better historical performance, we want to know whether the results are driven by historical performance that are driving the fund flows or the live stream itself. So we look at a class level analysis. So the mutual funds in China, a lot of them have dual classes. One of them is class A, one of them is class C. They invest in exactly the same securities. However, the fee structures are different. So when we look at the live streams, sometimes they only feature one class in the shopping carts, but the other fund in the same fund but different class. They have similar performance. They have exactly the same performance, exactly the same underlying security, but they're not included in the shopping carts. So we look at when the fund class is included in the shopping cart, does it drive the fund flows? So basically, we are controlling for everything that's associated with the funds itself, the manager's ability, their past performance, etc. And we find significant results here indicating that the live stream funds are indeed driving, the live stream itself are indeed driving the fund flows. The next one that we look at are intraday results. Now, for this test, the app itself, every 10 minutes during the trading hours, is going to produce a hot fund list. So basically, these are the funds that have higher inflows on today, basically during the trading day, and it's updated every 10 minutes of time. So if we look at these results, this is basically an intraday test. And we look at whether the funds included in the shopping carts in a live stream will have higher likelihood of being included in the hot fund list after the live stream starts. So basically, we are holding everything constant. We are looking at different classes of the same funds. One of them is included in the shopping cart. The other one is not included in the shopping cart. And what we find is that in the period that in the period or on the day that the live stream included one class of a mutual fund in the shopping cart, the likelihood of these funds being included in the hot fund list is significantly higher after the live stream starts. So we see this as a very strong result of causality that the live stream itself does drive does drive the inflows. So basically, in terms of economic magnitude, there's about a 55% increase in the likelihood of becoming a hot fund after the live stream starts, and the live stream includes the funds in the shopping carts. Now, we also do a placebo test where we repeated the intraday test 999 times and using a non-live stream day, and we find the results are we find mostly insignificant results, or at least the coefficients are much smaller.
Ellen, 5 minutes.
Yes. The next test that we do now that we have established that the funds live stream do drive inflow is that we look at how does that affect the investors' welfare. So we look at two sort of outcomes. The first one is the purchase decisions. Now, from the mutual fund industry, from the mutual funds literature, we know that investors tend to chase funds with very high past performance. And subsequently, a lot of these funds are not able to sustain their high performance. So we look at this return chasing behavior. And we find that live streams exacerbate the return chasing behavior. So basically, the likelihood or the effect of recent returns, prior returns on the fund flows increases about 50% for funds that are live stream compared to funds that are not live stream. So it worsens their purchase decisions. Now, the last set of tests that we do are looking at the returns of the funds itself. So we know that they purchased the funds. We know that the funds have high performance, but what happened to the return afterwards? Basically, what we find is that the returns are negative. The returns are negative, turns to almost zero during the quarter that they purchase, during the month that they purchase the funds, that they have the live streams, and the returns are significantly negative in the months following the live streams. And we look at the raw returns, we look at the industry adjusted returns. We also look at some other ways to adjust for risk. So the basic takeaway is that there are negative return risk-adjusted returns for the investors who purchase the funds. And because the results are negative, not just for the risk-adjusted returns, but also the net returns, we basically conclude that the investors are worse off, and they're better off investing not just in the market, but also just better off putting in cash and putting it under their mattress. So this is the test that we do in terms of the future performance. Next, we take a look at two type of persuasive behaviors and see whether more persuasive live stream funds, whether more persuasive live streams exacerbate the negative effect of the live streams on the investors. So the first one we look at is whether the fund managers are included in the live streams. If you remember, fund managers are included only in 27% of the live streams, but having the managers there could provide more information, because you know exactly what who the managers are that are managing the funds that you will be investing in, and they could also exacerbate persuasion. So long story short, we find that for when managers are on the live streams, the persuasive effect of the live stream increases because the fund flow increases 47%. But the results are even worse. So the live streams with mutual fund managers attending, the results are worse than, or at least the same as, the live streams that the fund managers are not attending. And lastly, we look at other type of features, persuasive features. We look at whether the funds are included in the top half of the shopping carts. We look at whether the linguistic tone is more positive. We look at whether the vocal sentiment is more positive, whether the voice has more higher valence, more arousal, and whether the speakers are more attractive. Long story short, we find that the flows are 6 times higher for the most persuasive live streams compared to the least persuasive ones. The results are significant when we look at each individual characteristics of the persuasive features, and when we combine them, the results are stronger. However, the most persuasive live streams also have worse performance compared to the least persuasive live streams. So they do attract higher inflows, but it could be that higher inflows are driving negative performance. So to conclude, we find that fund live streams are persuasive. We find that the beneficial effect of firms' social media in equity market does not really extend to the financial market, and regulators should be very concerned about about this type of communication that are under the umbrella of investor education. I just want to mention one caveat is that we do not observe the counterfactual. So we don't know what these investors would invest in if they're not investing in the live streams. Could be that they invest in cash, could be that they gamble their money away or invest in individual stocks, which could make their returns even worse. Thank you very much, and I look forward to the discussion and the questions.
Wow, fascinating, Alan. Thank you for presenting the paper here, and hope that more and more people listen to this one. Charles, we look forward to learn from you. I remember your wonderful beginning work as the closed-end fund, and now you're talking about this persuasion and information. Please help us to understand the paper, and please unmute yourself.
Okay, here we go. Am I unmuted? All right. Yeah, thank you, Alan, and thank you also, Bernie, for inviting me to give this presentation. It was a really interesting paper. I enjoyed reading it, and I'm happy to share with you some of my thoughts. Let me see if I can, I don't know why I'm not moving this. Oh, here we go. Okay, so I'm going to just 4 steps in this discussion. One is just speak more broadly about digitization of financial markets, which I think is very important, both to accounting and finance researchers. And then I want to talk a little bit about the motivation and contribution of this work in the context of prior work, talk about some methodology and result issues, and then conclude with what I learned, what I wish I could learn more about in this paper. So let me talk first about the digitalization of financial markets. This is the broad context in which I think about this paper. The informational underpinnings of markets, specifically how investors learn about and analyze securities, such as individual stocks, mutual funds, and ETFs, are changing very quickly. This is important because when we talk about digitization, we're not really talking so much about innovations in the trading, the auction, trading design. We're really talking about the information that underpins the price formation process. And taking China as an example, here are some platforms or financial portals in China, and it's useful to think about how they differ from each other. For example, companies like East Money and Tencent, they have these information aggregation or news platforms, and the main function is to provide information aggregation. And I think they're viewed largely as those things. And then we have these commercial portals, Ant Financial being the largest, but Tian, where this data comes from, would be in that category. These are portals that main functions provide various financial services, payments in the case of Ant, and in the case of Tian, mostly mutual fund trading and analytics. Tian is owned by East Money, so these are, I would call them commercial portals. They provide security-specific information and other financial services. Then there are other portals, I call them social investment forums, notably Xueqiu and Guba. These are, like Guba means a stock bar. This is a bar where you belly up to talk about your stocks. So these are really social forums. People get a different kind of utility out of those. They're talking and they're chatting and they're crowdsourced opinions. Okay. And then there are things that I've worked with, these interactive platforms. Investors post their questions to specific companies and the companies reply to them. Okay, these are IIPs, there are two main ones. And then finally, there are these microblogs. They're Weibo, WeChat, Douyin. These are similar to Twitter and TikTok. They can be used by firms to disseminate news. I think it's important to think of these, at least there are these at least 5 classes of things. They're really quite different from each other. They're sponsored by different people and their primary functions differ from each other. And this is useful because often we think of them as just social platforms, but they are not quite the same. So in terms of motivation and contribution, I think that we definitely need to better understand market digitization. The landscape is changing very quickly. So which portals are important? How are investors coming to these portals responding to digital nudges or things that are sent out by these platforms? What types of nudges have bigger effects? I think these are all important. And especially so because we are moving into an AI age. And I am teaching financial analysis and teaching stock screen valuation. I find AI is rewriting everything. And I'm basically training my AI bots to go out with prompts, and we can actually do a deep dive on a single company with a single grab. So it's really changing everything, and I'm just sharing with my students how I do it, and then they can tell me whether they can do it better. So I think that we need to do research on this, and this in particular, the focus on how investors react to digital nudges and signals on these platforms can be very valuable. In a study like this one provides a direct link to specific signals and observed actions, and I think and investor actions that have market impact are especially important. Some of these affect the investors themselves, but some of them affect market outcomes that affect other people, not even just the people who look at them, like having stock return impacts. So for all these reasons, I find this study very well motivated. I think it has potential for significant contribution in the literature. Now, let's look at more closely on the research questions. Why might we be interested in understanding, what might we be interested in understanding about each of these financial portals? One, we might ask, do they affect investor behavior? Do investors use them? Do they respond to digital nudges from these things? What types of nudges have the biggest effect? Number 2, do they inform or persuade? Do they induce actions that lead to improvements in investor welfare, utilities, or decisions? And number 3, do these induced actions have market impact? By which I mean, do the nudged induced actions have economic consequences for resource allocation decisions by other people, other than the people who have reacted to them? Do they impact stock returns, market liquidity, fund flows, and other outcomes? Okay, so to me, this is the way I think about when I think about digital platforms. These are the questions that come to mind. I know that the authors are not focused on all these questions, but I just thought I should lay them out as a generalization of this landscape. And in terms of this paper, I would say, 5 stars out of 5 for whether or not this particular stimulant, this digital nudge, affects investor behavior. I think it's very clear that the evidence is very compelling that it affects, it causes investors to move their money into these funds. Do they inform or persuade? I would say there's I would give 3 out of 5 stars. I think there's a lot of evidence that it persuades. No evidence that it informs, but then the design of the test does not maximize the ability to detect information. There's actually, the focus is primarily on persuasion. So I would say 3 stars. And then do these induced actions have market impact? There's much less discussion of that, and I think it would be nice to talk a little more about it, and I'll explain why. Okay, key findings. Let's see. How am I doing? 25. Okay, good. I lost it. Does live stream affect investor behavior? Alan made a very good presentation of the results, the main results. Yes, live streaming increases inflows to the future funds. The evidence is very convincing to me. The inflows increase sharply in the quarter. It reverses to normal by 2 quarters later. Figure 1 is very compelling. Table 4, the class in cart finding is really compelling. You're really looking at the same fund, whether it's just a question of whether they're in the cart. The placebo test is compelling. The intraday flows, the 55% increase in the probability of becoming hot, very convincing. Sections, oh, by the way, the paper is 92 pages long with supplemental material. That is a lot. 68 pages are the main text, and then the rest is supplemental material. And in there, they do all sorts of other tests, interview balancing, potentially score matching, stops and starts, all very consistent. And then table 7 and 9 even extends that and talk about the role of the manager, the voice, the vocal attractiveness. So all of this convinces me that live streaming affect investor behavior. In fact, investors are clearly moved to action by these sessions. It works well as a piece of advertising. In fact, the later tests are almost an overkill unless you're submitting to a marketing journal. I think it's it tells you the different layers of persuasion and which triggers cause the persuasion to be more compelling. Maybe it tells you something about the persuasive technique. Maybe it tells you about the self-selection, that those types of funds are more likely to need to come here. So in either case, I think this particular point is very well made in the paper, maybe a little bit almost oversold for an accounting audience. The question really for me, and it's in the title, does live stream inform or persuade? So do investors who watch these live streams make better decisions? Apparently not, because they're buying expensive funds with strong trailing performance and then bad future performance. In table 5, we see that there's 50% more responsive to past returns if the fund is featured in a live stream. Table 6 shows these live stream funds earn abnormal returns in the past months, and they earn negative normal returns in the future months. Again, the evidence on persuasion is very clear. But the title is suggesting that we can reject the informativeness hypothesis, but these tests are well executed for the persuasive side. It's very difficult to know whether or not there is information in here, at least not with these tests. And so the novelty of the economic insight is a little less clear to me. And in particular, there are 3 questions here. What is new about this live stream setting? Can these tests reject the informed hypothesis? And why do funds subsequently underperform? To me, these are 3 very useful things to think about. One is, what is new about this live stream setting? These findings are very consistent with the effect of print advertisement in Jen and Wu. As Alan pointed out, in that paper in the Journal of Finance, print advertising has the effect of hurting people, funneling people into higher fee funds that tend to underperform. So the paper tries to make a distinction between this setting and advertising. And I found Alan's presentation more compelling than what was written in the paper. I think that maybe writing it more like the slides might help. But in the paper, it says the contribution of our paper over existing marketing literature is to examine a fundamentally different communication mechanism that ex ante is possibly informative instead of persuasive. That's okay. I understand the goal. But it goes on to say live streams often provide general investment advice that plausibly help investors make wise decisions. I think it would be very helpful to have some examples there, like I saw in the slides. So also, how would you test for this? If they're plausibly making plausibly wiser decisions, when would you see that? Who benefits from CAPMs? So I think there's nothing there to test for. I mean, theories provide compelling reason. There's this statement in the paper that theory provides compelling reasons why live streaming can be informative. I'm just not sure what theory, because I didn't see a lot of citations on theory about the informativeness of these things. China regulators permit live streaming for the purpose of investor education. It would be nice to have a quote there where they say that, because I found it more compelling in the slides. Perhaps most importantly, live streams are explicitly intended to be educational, and research from equity markets find that firms' social media usage, emphasis my own, improves investor decisions. If I showed you the overall layout. When you look at these other papers that are cited as being supportive of social media being positive, really they're very different. You have strategic Twitter tweets, 4 of those papers, two papers on interactive platforms, and one paper on say platforms in the US, which are interactive, small version of the IIPs. So I think you may need to make a stronger case for why we should even expect educational benefits. You might do it verbally, or you might do it with tests that look for it. But even since the host platform is commercial, maybe we are entitled to some skepticism to begin with. And since the basket of live stream firms are inherently bad, it doesn't seem like you can inform unless the thing to do is watch these things and just short the market, or something like that. So I think it would be helpful if there are some tests that show how they actually respond and whether there are certain ways where they're even plausibly going to be able to make better decisions after watching it. So maybe some people watched the live streams and were informed, and they elected not to invest in the fund. In fact, they sold all their other stock holdings. Is there any way to detect that? I think it's very difficult. The problem is that the finding seems predetermined once we know that these funds as a basket are a bad bet. So it seems like no matter how you persuade, how you talk, you are only kind of making it potentially worse. I don't mean that the other findings are uninteresting. It just seems like from the point of view of financial markets, they may not, they simply really emphasize the persuasion side. Now, Bernie shared with me a working paper, which I understand he also shared with Alan, called, which Bernie is a co-author on, called Digital Transmission of Financial Evidence, Financial Knowledge, Evidence from Stock Market Investments. It's not totally clear to me whether or not this the data set is the same as the Tian data set here. Bernie and his co-author, Gu et al., talk about, they got this data that's randomized. It's provided by an anonymous fintech company, one of China's largest online investment platforms, which caters to over 1 billion customers. That really narrows down the field, folks, including 711 million monthly active users. So I figured this has to be either Tian or Ant Financial. Now, this paper's research questions whether and how digital nudging and transmission of financial literacy on a digital platform, commercial digital platform, lead uninvolved and inexperienced households to invest meaningfully in the stock market. the setting is that there's a randomized distributed monthly prompt on these platforms. And the main finding is that these prompts increase investor information acquisition activities after getting prompted. Because it's randomized, you can kind of see after being prompted, the treatment investors actually are more likely to do more fundamental research on that platform, and then they're more likely to invest. And there is some evidence in the paper that the treated investors actually earn higher Sharpe ratios. Okay, so here's an example. If that in the right setting, digital nudges, even on a commercial platform, may be informative and helpful. So I think that it would help this paper actually to discuss those findings, because it gives more tension to the process. I don't mean to suggest more sites. There are 5 pages of tiny fonts, single-spaced citations already in this paper, but I think that this is a very useful one. Okay, and then so here the 2 main questions I've talked about. One is, do these live streams affect investor behavior? And the answer is clearly yes. And do they also inform? The answer is not in this paper. Okay, not necessarily that they don't inform, but the conclusion may be context specific. The last question, which the paper does not really address, but it sort of begs this question, is, do the induced actions have market impact? This is important because if they do, then these nudge actions have economic consequences for other people. And I think it's very likely that they do. But it seems like it's hard to explain this result about future returns without some sort of causality here. If you look at this table 6, I'm just picking panel A. This is a summary of the net fee returns and abnormal returns in the months adjacent to the live stream. And you could see that, the returns coming in are all positive. In the month of, this is relative to cash, right? So in the month of, these funds earn negative returns. And after that, they're all negative. And in fact, if there's minus 2.29% in the next 5 months in terms of their underperformance relative to cash. It only does slightly, the performance is after you subtract index funds, you still see the same pattern. You have an inflection point in month M. And so the implication is that upon seeing a live stream, the best thing you can do is to sell the fund and hold cash. And short of that, at least sell the fund and buy the index. Both of them will save you some money. But the question is, how are live stream sessions able to time the market so well? Like if you can tease out the market just by taking the first row, subtract the second row, right? You can see the market return also reverses. I mean, coming in, markets are positive, and going out, markets are negative. So it looks like most of the live streams are happening when markets are fairly hot and are ready to turn around. And so self-selection within the fund family, meaning that the fund manager is picking the best performing, maybe idiosyncratically best performing funds. That's only a partial explanation, because that should suggest we have random outcome in the future month. It doesn't suggest negative. I mean, it takes skill to reliably underperform. So what is the nature of that skill? Okay, so I'm getting close, right, Bernie? Are you?
Yes, I'm showing that you have 4 more minutes.
Oh, you are so generous. Okay, I can give you change on the 4 minutes. Okay, so could this pattern be causal? It seems to me it's very likely that it's causal, because so by causal, I mean, well, we induce a bunch of people to buy the fund. That somehow creates fund-induced trading, flow-induced trading that leads to excessive demand on the underlying securities held by these funds, which then reverses. We know about this. It's called flow-induced trading in the US, and there's a large literature on it. In fact, you can tease out the flow sensitivity of returns for individual stocks in the Liu paper. There's a method for computing that. So the question is, do we know whether or not flow-induced trading occurs in the US? And is live streaming making this worse? And so to me, that seems like almost the only reason I can think of that allows me to For some reason, I mean, of course, live streams tend to, when people are more desperate about gathering flows, they're more likely to advertise, and that might be part of the reason why we can time markets. But this is a puzzle that seems to be big to be asked. Okay, last slide. What did I learn, and what do I wish I could learn more about? Number one, I think this is a really interesting study. It contributes to our understanding how digitization is changing financial landscapes. It adds to our understanding specifically about the impact and implications of digital nudges, namely mutual fund live streams, which are pervasive and I think important of their own right. So I think these are strengths. And so what else did I learn? I learned, remember, if I watch a bunch of live streams, I got to sell that fund or short the market or both when I see a lot of live streams. I know it's not easy to short in China. That may be one reason why it's hard to act on it. The other is, what do I wish I could know more about? Number one is perhaps this platform also serves an informational role, and Bernie's paper seems to bring that out. And number two, do live streams cause the price reversal? To me, that would be very interesting to know. Okay, that's it. Thank you. All the best to the authors on this paper.
Wow, Charles, this is wonderful. I learned a lot from you. Thank you. And a lot from Alan too. By the way, I really love this community. Last month, I present my paper, and this month, Alan presented the paper, and Alan has given me very, very useful comments already. And now you're giving Alan very constructive comments and expose all the things we need to. So I just love this community. Thank you very much. And also, in this area about digital, etc., Xiaoyan is really an expert. She knows so much about all the retail trading in China and so on and so forth. Would you like to make some comments, Xiaoyan?
Well, thank you, Bernie, for
Alan's work is Ellie.
for giving this opportunity to me. Hi Charles, I haven't seen you for 10
Hi,
years.
I almost didn't recognize you. Great to see you.
Yeah, me too. Charles has been my referee and my mentor for many years. It's good to see you guys. I really learned a lot from today's presentation and very insightful discussion. I'm going to share 3 parts. The number one part, you guys might find this funny, but I have to say that there's a lot of interest on how social media affect people's behavior, especially retail investors' behavior. I have to admit that the accounting team is doing so much more than the finance team. I actually taught many accounting papers, including Charles, your paper on IIPS in my class. I feel like you guys, Alan, was this live streaming. We talked about that. We never worked on that. But we really, really feel like you guys are leading and doing a lot.
Sorry, I love to interrupt. We are all economists.
Yes. Okay, I'm not trying to separate. Charles always lead finance as a accounting professor. He has already done that for past 30 years. Okay, my second comment is I actually agree with Charles. When I saw this for the paper, I like the part that's describing the data and showing the very stylized empirical patterns. But I feel like, Alan, I wish you guys have a comparison. I didn't read the paper as carefully as Charles did. I wish there is a baseline. How is this different from other type of information disclosure? For instance, if the companies are issuing, performance or commentary instead of live streaming, those are still information disclosure by the company, by the fund company, by the fund managers. How is that different from this? Because I want to separate, digital nudge or the regular information release, how they are different. I feel this is where the contribution of the paper is going to be. Of course, there are a lot of fascinating patterns in the paper already, but I feel this is the part that's separating the paper. In terms of whether it's informed or not, Bernie's paper and many other papers are also talking about that, but I feel like live streaming is is the place to go, and how is it different from the other type. My third comment, I like, Charles, your very big table of all kinds of information in Chinese market, especially using digital channels. I also like the part you give us stars. But when I think about it, because we're currently working on a project related by CSRC, and the East money is in our discussion group, and the idea is about how much, what do we think about information disclosure? And Alan actually asked that question at the very end. How is this really information provision, or is this a marketing campaign? How would the regulators think about this? Are they talking about factuals, or are they providing some persuasive but not necessarily fair suggestions to the investors? I know in United States, we have Reg FD from 2004, and we don't have necessarily something comparable in China. And I also want to add one more to it. That is, when investors looking at those live streaming, they might want to be persuaded if they know, okay, they might want to be informed, but there's another motive, which is I'm watching the live streaming, I want to be entertained. I want to be entertained. And then, because you entertain me, so therefore that's why I'm paying 10 Chinese yuan to get your product. So that's something, also happening with a lot of younger people, given this large population of retail investors in China. So Bernie asked me to say something. I just feel like this is a very booming area. I really appreciate all the work by Alan and your team. And Charles, please share your slides. I will teach that in my PhD class. Thank you.
Alan, I'll give you time to respond, but let me just add a few things here. I want to again thank the community, and as Charles said, digitization is changing people's behavior, whether it's investors' behavior, savings behavior, on consumer behavior, and it's also changing the market pricing and valuation, and affects resource allocation. So I really appreciate what Charles started, and I would love to post Charles' PowerPoint on the ABFER website. Then a few things I think researchers will need to learn from this, and I don't know how to handle it sincerely. Number one, what Charles said is really that beware that what we do may have an inevident sample bias that affect us to really understand the subject matter in a comprehensive manner. And then the second big thing that I think Charles pointed out is the challenge in finding out what the users of these exposures learn. I mean, do they learn, do they not learn, and how we capture after they learn and they retreat, etc., etc. So these are very big questions that I think they are not criticism, but really is an important message that I think the whole research community need to pay attention to. And my third point is really I spent 17, 18 years in Singapore, and a lot of time in China too. I'm thinking about, is there anything sensible we can say to the regulators? And I know that they will do something. So any advice at this point? So these are my big area questions. We need to pay attention to this. We have to watch out for our sample bias, and we have to watch out for how we can capture the learning aspect, how it really changed, how it seep into the user's mind. And finally, we have to worry about proactive regulators. What should we say to them? Thank you. So Alan, please, your turn.
Oh, thank you very much. First, Charles, I love your discussion. Really appreciate it. Love the 5-star rating on the first point. And I will think more about how to improve the other stars as well. And Xiaoyan and Bernie, thank you very much for your comments as well. I especially love how you organize the different tech platforms, different platforms providing different information, serving different roles. And I think at the end, I did caveat that we don't know what's the counterfactual, which is my way of saying that we don't know whether they learned something, and could be that, you know, if these are the people that actually tune into the live streams and they're influenced by someone saying about AI and then just buy his funds, maybe they're easily persuaded to just buy a single stock. And in that case, they you know, people are buying mutual funds like stocks in China. And in China, as you can see, there's a 7-day redemption period that if you redeem within 7 days, there's a very high fees. And the regulator introduced those fees because Chinese stock market investors are trading mutual funds like individual stocks. And I was at the I would hope that I can get Bernie's data or something similar to that, where I can observe what those investors are doing if they're not watching the live stream itself. Now, in terms of whether it's providing information, I think that the live streams itself, personally, when I watch them, I felt like that they are providing information. It is just whether that information is really helpful for the investors' investing decisions. So, for example, when I watch the live streams, they're very particular about what type of information they can disclose. They usually don't say, come buy my fund is going to do very well. They don't predict any future performance of their funds. So all they say is how much I know about this industry, what I think this industry will do. So after watching the live streams, I figure my takeaway is that, okay, I learned something about this industry. And moreover, I think this guy really knows a lot about this industry. So if I were to invest, I should invest in his fund. So this is kind of the information that I learned. But then unfortunately, that information is not really translated into the buying decisions, into more optimal buying decisions. But the last part of I want to comment is that the causality with so basically what is driving the negative returns. Now, personally, we haven't been able to figure out a way to test that yet convincingly. So currently, our causality is more from whether the live streams lead to the fund flow part. And I think it will be helpful if we can say whether the fund flows are the reason of the future performance. So basically, whether they are tracking too much flows, that either is there buying pressure on the underlying stocks, which drive the lower returns, or that these are the fund's investment strategy has an optimal point and they're drawing in too much funds. It helps their AUM, helps their fees, but then they don't have really good investment opportunity to put in those funds, and that's what's driving the negative results. But let me think more about and discuss with my co-authors on that.
There is a well-developed methodology for extracting flow-induced trading pressure and the predicted reduction in expected returns in future months. That approach was done in Liu et al. Liu first, and then adapted by quite a few papers. But it's in the finance literature. But so you can do it, but it's a lot of work, to be honest, because you start with the fund flows, and then you have to trace them down to the companies, and you have to predict the difference in the company returns, and then you have to reaggregate to see what that does to the performance of the fund. So it is not a particularly fun thing to do, but maybe you can just say
and that's another paper.
Yeah, it is, and maybe it is, and maybe you can say that. But I do think that it sort of begs the question. You sort of leave it out there,
right?
But it's the question.
No. When I'm saying that it's another paper, I'm saying in a good way that's another project we're gonna do.
Yeah.
Well, let me take the chance to ask Charles. Sorry, Xiaoyan, you're going to say something?
I just have one very simple question. When Alan says there is no counterfactuals, I feel like the data probably does have counterfactuals in the way that there are some funds they don't broadcast, they don't have live streaming. And then for some funds, they live stream some days, but not other days.
Right.
Of course, this is related to causality, but if you randomly choose them, you do have some counterfactuals. And finally, if this data is coming from East Money, we can ask them to give a small sample.
I would say
we have the counterfactual at the fund level, but we don't have the counterfactual for the investors.
I would say
we can,
A good, useful paper is one that stimulates us to think more and to do more. So I would say on that, you all also got another 5-star. We have a few more minutes, but I would like to take this opportunity to ask Charles a question. Okay, this is for the benefit of the younger people among us that we may not see their face. You mentioned one thing about how can we capture the users learning from all these live streams and so on? Do you have any thoughts on how to tackle that question?
Yeah, I think that, you know, the paper you share with me does address that. I mean, does try, at least if the goal is to.
We use the result, but not the actual learning.
Yeah, with the thing with your, I don't mean to take it off topic, but with your, it seems like they do more research and then they invest more into markets. Well, that's a good thing in the US, but not necessarily a good thing in A shares. Because when you look at the long-term performance of the A shares, there are some structural issues. If you talk about market reform, there are structural issues with the market that is not going to be addressed by, you know,
Right.
trading mechanisms. And I mean, it really does go back to things like tunneling and
Yes.
and new entrance restrictions and how firms, you know, if the paper by Franklin Allen and co-authors recently, I mean, you're probably all familiar with that. I mean, the A share market earns 0 while the economy goes up quintuple and in 18 years. And meanwhile, the Chinese, it's not like the Chinese companies aren't making money. The overseas Chinese companies outperform the S&P. So these companies that operate in China self-select to list overseas and then do way better. Now that tells you something about the implicit cost of the way the regulations are set up in the A share market.
Well, all Asians are doing better.
Well, that's like saying sometimes it's sunny in Seattle, Mike, sir.
No, you get rings all the time. Okay, so we're about to close. Any last comment from Xiaoyan or Ellen?
No, I wish, well, I do. I wish I can invite you guys coming over to Tsinghua to, you know, communicate with our students and faculty. We definitely have a lot to learn, and including what Charles just mentioned, the cross-listing, the issue, and everything.
Hey, all you need is to buy the ticket, and we all three of us.
Yeah, we will. Welcome to come.
Yeah, I was gonna say last point is that we do have like 27,000 hours of video, so they do answer questions. So I have heard I've listened to a live stream. They do answer live questions. So there are tests that we can do to look at under what scenario they're more likely to learn, actually getting information from the host. So more tests to do, maybe another paper, but but yes, thank you very much.
Thank you. I want to thank you all. What you illustrate is really the digitization is a very important topic. And it takes the whole research community, each contribute a tiny bit for us to together the paint the big picture that can help us to understand this imminent, important, arriving phenomenon instead of imminent. Really, thank you very much. I feel very stimulated. And sorry, I got so excited that my blood pressure is going up. I should take you now. Thank you very much to everyone. So by the way, we'll pause a little bit because we're close to the Christmas, if I may say, 1 month from now. And so we'll feature something else, something exciting in January. Thank you very much, everyone.
Thank you. Bye-bye.
I hope you're okay for us to
see
post
each
all
other.
the PowerPoints on the web, right? Okay.
Yep.
Thank you.
Yeah.
Thank you, everyone.